Hello and welcome to the world of accounting. At this point in the semester, you probably are coming in with some misperceptions of accounting. You probably believe accounting is extremely boring and mundane, and that the people that actually decide to be accountants must have no social skills or desire to interact with other people. They lock themselves in a cubicle only to deal with numbers day in and day out. That truly is as far from the truth as possible. Accounting is the language of business. Accounting is communication. Without the ability to understand accounting, you'll not be able to effectively communicate in business. You may believe that you can just hire an accountant and they can do all the work for you. But if you don't understand the fundamentals, that leaves you open to be taken advantage of. You need to understand the fundamentals of accounting so you'll at least be able to ask the right questions in your future and look for the red flags or warning signs that you may be taken advantage of. Accounting is also a great career opportunity, so I'd like you to all open your minds to the prospect of accounting as a career. As an accountant, I dealt with people each and every day, not only the people that I worked with, but also several different clients in different types of businesses. And I really use my knowledge of accounting to help them make their business better, to help them make their business grow. And what I found really interesting is I also was able to help them uncover instances where they were being taken advantage of and fraud was occurring. In order to do the more interesting things related to the accounting discipline, you have to learn the fundamentals, and that's what this course focuses on. In addition, accounting careers really offer some exceptional opportunities. Our placement rates are extremely high, as are the starting salaries. So keep that in mind, and as I like to say when I'm meeting in a face-to-face environment, open your hearts to accounting, take the hate right on out so you can fill it with knowledge. And I think you'll find that this class isn't nearly as bad as you think it could be. Accounting really is a giant puzzle, and we have to figure out which pieces connect in order to make the final picture, which will allow us to make effective business decisions. So the first thing we're going to do is try to get an understanding of the business. A business is really no different than you or me. We need resources to survive, right? So in its simplistic form, we need money. Show me the money. Where am I going to get the money? So a business is no different. They need money to survive. So how would you get money? Well, if we were together, I would imagine you'd tell me things like you'd get money from your parents, or you'd work for your money, or you'd borrow the money. And a business basically has those same options. No, they can't get money from their parents, but they can get money from stockholders. Stockholders would be the owners of the business. If you ever watch Shark Tank, the whole point of going on to Shark Tank is to get money from the sharks. And in exchange for that money, in most cases, the company gives up ownership. So the shark can own part of that company. So that's what stockholders do. They make an investment in the company and they hope for a future return. How are they going to get returns? Well, two ways. One is when the company is successful and has excess cash, they'll give some of that money back to the owners in the form of dividends. The other way is if the company is successful, the stock price will increase, and then the investor can generate additional income by selling the stock at a future price that's higher than what they originally paid. Of course, it doesn't always turn out like we want, and in some cases, new businesses aren't successful and they go down in flames. And the stockholders are left with nothing. But without risk, there's no reward. So one way a business can gather financial resources is by selling stock to stockholders. Another way is to borrow the money. Just like you may borrow money to go to college or to pay for your car, businesses borrow money to finance their operations. They borrow money from people that are called creditors. That would be the bank. And one of the downsides of borrowing money is that you have to pay interest. In addition, you also have to pay back those creditors. You have to pay the loan back. When you get money from shareholders, you have no obligation to pay it back. Yes, if the company does well, they'll give out dividends, and if the company does well, the stock price might go up, but the money never has to be returned to the owners directly. And though it's not shown on this slide, the other way a business would generate financial resources is by earning it itself. So by selling goods or services, the company can generate cash flows that they're able to use to grow the business. So a business, again, is a lot like you and me. We get our money from gifts or parents, friends, like stockholders. We earn it ourselves with a job, like a company selling goods or services, or we borrow that money. And again, the downside of borrowing for a business and for you and me is that we have to pay it back with interest. So the accounting system, as I mentioned earlier, is used really to make decisions. There's two overall types of accounting: financial accounting and managerial accounting. This course focuses on financial accounting, and we have a separate course that focuses on managerial. Financial accounting focuses on external decision makers, like creditors and investors, those groups that we just talked about. There are other external decision makers as well, like customers, suppliers, government entities. And then there's also internal users like managers. Managers are going to use financial accounting information, but the overall goal of financial accounting is to provide useful information to external decision makers. Internal decision makers like management will also use this information to make decisions, but again, the primary focus is to summarize what's happened in the business over time and provide that information to the external users. Financial accounting is also used to create managerial accounting reports, and obviously the goal of managerial accounting would be to provide managers with information to make decisions. So the focus of managerial accounting is internal decision makers, the people that run the company. This information is generally not going to be provided to external users. So managerial accounting reports like budgets and projections are used for internal decision making and not provided to those external users. Again, our focus is on financial accounting, and the focus of financial accounting is historical. It focuses on the past and summarizing past transactions. Managerial accounting is much more future-oriented, which means it's very relevant to decision-making. Looking to the future is very relevant in decision-making, but financial accounting, being historical, is more reliable. There's three basic categories of business activities: operating activities, which are the activities related to selling our goods and services and the costs associated with providing those goods and services; financing activities, which deals with how we finance our operations, how we get the money to survive, and that would be debt transactions like loans, as well as equity transactions, which relates to shareholders, getting money from investors. And then investing activities would be utilizing funds within the business to grow it, like buying a new factory, buying property and equipment, or buying investments in other companies. We'll talk more about all these different types of business activities later on. Why do you care about financial accounting? Well, in addition to the information I provided earlier, decision makers rely on financial information. It's the only way they're going to be able to make their decisions. Investors are going to want to determine if the company is worthy of investment. Are we going to be able to get some return on that money we're investing up front through the form of dividends or stock growth? Creditors want to know, can this company pay the loan back? Will they be able to afford paying interest? Managers within the firm also use the information. Marketing managers are going to use the information to determine if sales are progressing as anticipated, if the new ad campaign that they implemented is useful or not. Credit managers are going to use financial information to determine whether or not a customer is worthy of extending credit. Do we allow them to buy things and pay for them later? Supply chain managers are going to use financial information to determine whether or not they have the goods that are needed, when they're needed, to be provided to customers in the future. Human resource managers are also going to use accounting information to make decisions, such as, do we need to hire additional personnel in order to meet an increase in demand? There are 4 basic financial statements, and that's what we're going to spend most of our time in Chapter 1 discussing. Really, what Chapter 1 does is it starts with the grand finale of accounting, and that is those 4 financial statements. Imagine from your experience in high school or junior high when you had to read a book and you didn't want to. When I was a kid, we'd use what we call Cliff Notes, and you probably use something similar, maybe Spark Notes. And basically what it is a summary of the entire book, maybe some common questions and answers of things that are asked related to the book. And the reason we look at those Spark Notes or Cliff Notes is because we don't want to read the entire book. Well, the financial statements are no different. Companies have thousands, millions, even billions of transactions. And there's no way we want to look through all those different transactions in order to determine whether the company is successful or not. So instead, we turn to the financial statements. The financial statements are the Cliff Notes or Spark Notes version of what's happened over a period of time. And they tell us whether the company is successful or not. There's 4 fundamental financial statements that'll summarize the activities of a business. The first is the balance sheet. This is the only statement that's a snapshot or picture at a point in time. So it's like taking a picture of somebody. It's what they look like at that one point in time. And the balance sheet reports the financial position of the entity at that one particular point in time. The financial position will be demonstrated through its assets, which are things that give the company a future benefit, its liabilities, which are the debts that they owe, and then the equity, which is representing the amount they've either received from investors or they've earned through providing goods or services. The income statement and the other 2 statements, statement of stockholders' equity and statement of cash flows, are all prepared for a period of time. And that can be for 1 month, it could be for 1 year, it could be for a quarter. It just depends on what information the user is interested in understanding. An income statement is going to report revenues less expenses. Well, what are revenues? Those are the inflows from selling goods and services. The expenses are the cost. So very simply, you go to Walmart, you get yourself some paper towels. Walmart sells those paper towels for $10, but it costs them, say, $7. So the revenue would be related to what the paper towels are sold for, $10, whereas the expense would be the cost of those paper towels to Walmart, or $7. And the difference would be the profit. There's obviously other costs that the company needs to consider. In addition to just the cost of the paper towels themselves, there's the store, the rent for the store, the equipment in the store, the employees in the store, etc. But the income statement is going to show us whether the company is profitable or not. Are they generating more revenue than it costs them to do so? The statement of stockholders' equity is going to report changes in the stockholders' equity accounts. And we'll learn a little later that there's 2 main components of stockholders' equity, which I've alluded to earlier. One is the money we get from investors. That's going to be the common stock of the company. And then the other is the amount we generate from selling goods or services, and that would be the retained earnings for the company. So the statement of stockholders' equity is going to describe how retained earnings changes, which is the result of earning income and giving it back to the owners, as well as new investments, which would affect contributed capital. Again, at this point, don't get overwhelmed. We're going through a lot of information, and we're going to drill down into each one of these concepts and statements a little later. Finally, the statement of cash flows is going to report the inflows and outflows of cash during the accounting period. And it's broken up into 3 categories: operating, investing, and financing, which we mentioned earlier. Cash is extremely important. A business can't survive in the long term without cash. But as we'll learn, when we prepare an income statement and record revenues and expenses, those don't necessarily relate to cash flows. Revenue is recorded when we earn it, which is when we provide goods or services, not necessarily when cash changes hands. And expenses are recorded when we use them, not necessarily when we pay for them. With that said, we still need to know when the money's coming in and out of a business because we need cash to pay for things. That's how we survive. It's nice that I'm making money right now as I record this video, but it really doesn't do anything for me until I get my paycheck next Friday. So you have to understand, yes, there's the earning of profit, but then when do we get that money? And that's what the statement of cash flows is going to help us understand. And we're going to talk about each of these financial statements in more detail. As I mentioned earlier, the financial statements can be prepared at a point in time, such as the end of the year, quarterly, or monthly. Remember, the balance sheet is at that one point in time. It's a snapshot or picture at that end date, whereas the other statements, the income statement, statement of shareholders' equity, and cash flow are prepared for a period of time, so for the entire year, quarter, or month. A financial statement heading is going to generally have the same information, which is going to be the name of the entity, the title of the statement, balance sheet, income statement, etc. The specific date of the statement. If it's a balance sheet, it'll be at December 31. If it's an income statement, it would be for the year ending December 31. And then a unit of measure, because a lot of times we're dealing with large companies and the amounts are shown rounded to the nearest thousand or million or sometimes billion. So that'll be specified on the statement as well.